Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure 5 to 10 unit property loans. Give us just a second here to go live on all the platforms. Appreciate everybody tuning in nice and early. Go ahead and drop a comment there in the chat as you tune in. Hope everybody's been having a great week so far. Appreciate those comments coming in already. All right. All right, looks like we're live on all the different platforms, so we'll go ahead and get it started here. We'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat, and go ahead and drop any questions you have in the chat as well, and we'd be happy to answer them here after Jose goes through the presentation. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is a deep dive into a different loan officer training topic, and tonight's topic is going to be how to structure a 5 to 10 unit property. Now, again, we do specialize in non-QM here at the Mortgage Calculator and working with investors. So it's something we're very familiar with and that we get a lot of requests for. So Jose, let's go ahead and get into it and talk about how to structure 5 to 10 unit property loans.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure a 5 to 10 unit property loan. Those are considered small multifamily properties. Now, if I were a loan officer just starting out in the business and looking for a couple of niches, this is definitely one of the niches that I would look to work, because you're going to have very little competition. There just aren't really a lot of MLOs out there willing to venture into the unknown or out of their comfort zone to originate 5 to 10 unit small multifamily loans. However, at the Mortgage Calculator, we have a couple of interesting twists to this type of property, which I'm going to bring up in our presentation, which is why I absolutely love this product, because this is commercial type product, but we have our additional options, and I'm going to get right into it right here so I don't spill the beans before we get to the slide. So 5 to 10 unit small multifamily defined. What are we talking about? Common misconception here when we're saying 5 to 10 units. Some MLOs new to the business may think that we're talking about 5 to 10 individual properties, right? Which would be units in that way. But what we're really talking about is units within one building or one property folio number. I guess that's the best way to put it, because we could have, for example, we could have a 5-unit property with 5 single family homes on an acre lot. Everybody has their little piece of land there to separate themselves, but it's all one folio number with the 5 properties sitting on there. And even though there may be fencing separating one space from the other, it's all one big lot, right? One folio number with 5 structures on it. Or it could be one building with 5 units, 5 individual units inside the building, 5 family units, let's call it that way, right? 1 unit per family. So units, like I just mentioned, can be attached or detached. They are not individual properties with separate folio numbers. So if you're looking at something there and you see individual folio numbers, folio number is attached to the land. That means you have more than one piece of land. That means that you have multiple properties, not multiple units. And now this program that we're talking about is for residential units only. We do have our mixed use option, which is not the one we're going over today, but which is the sister option of this one. But today's presentation deals with residential units only. Now, here's what I was mentioning about we have different twists to the options here, because at the Mortgage Calculator, not only do we have the regular commercial option, right, what everybody's used to reaching out to for these 5 to 10 unit multifamily loans. The thing about the full commercial option is that they will not originate the loan if the population density falls below a certain threshold. Um, what that may mean, what that amount is really going to depend on their individual guidelines, but they're looking at how many people per square mile, right? They don't really like it to be a low number, and they do have their amounts, and those do vary from outlet to outlet. However, in our DSCR hybrid option, where we combine a lot of the features of a 1 to 4 unit residential DSCR loan into this 5 to 10 unit DSCR loan to simplify the matter, not worry about population density, simply worry about, is it going to be designated as a rural property, RURAL, rural. That's like a tongue twister. So our DSCR hybrid option, again, doesn't look at zip codes, doesn't look at population density. No issues there. So why is the DSCR loan program good? I mean, why do we love that DSCR hybrid option? And we're mainly talking about the flexibility that the guidelines offer the investor to be able to get in on the property. We already mentioned one, right? We don't have to worry about population density. So you know that some of the better deals come up in those lower population density areas where they're still getting good rate of return on their rent. They just have less people there. It may not be a rural in nature property. So, why not be able to do the loan just because of a simple population density number? So that's why we love it here. And that's why I definitely would recommend this program um, as one of your tools to be able to offer. Now, there have been some changes because in this program since the last presentation, because the market is evolving, right? We mentioned this all the time, how non-QM's liquidity is increasing. And when the liquidity increases, that means there's more players in the secondary market looking to buy this type of product, right? So greater liquidity is going to usually mean more relaxed guidelines, right? They're trying to open up the market to get more business. So not only are they going, they're basically going to give us favorable options. So not only may they, mess with the LTVs, but they also are going to tweak items like the DSCR. Previously, we needed a minimum 1.1 DSCR to be able to do this option. But now, due to all the different options that we have, we can go as low as 1.0 DSCR up to $3 million. Now, please note that there are some differences in this program when compared to our usual DSCR. I mean, you're not going to get everything you want, right? They got to put some amount of restrictions. So, purchases will use the lower of the current rent if the property is occupied. Like they go into the property and they ask the tenant, how much rent do you pay? Tenant says $1,800. That's what they're going to put on the appraisal that the tenant is paying, unless a lease has been provided. Sometimes there is no lease. So purchases will use the lower of the current rent or the market rent on the appraisal 1007. Refinances will use the lower of the lease or the market rent on the appraisal 1007. Now, notice how this program treats vacancies. Vacant units get anywhere from a 10 to 25 reduction in rent off of the market rent. Obviously, if it's vacant, it's not rented, so we go with the market rent. And that's going to depend on how many units are vacant on the reduction that they're going to give, unless the property is being used as a short-term rental. Please note there's a maximum 35% vacancy allowed on a refinance, again, unless the property is being used as a short term rental. Now, keep in mind also the following: we have multiple options for this program, more than one. So these guidelines are a combination. and whenever I can, I'll state that this is one over the other. But just note that this is all is good because it shows the flexibility that we have in being able to place the borrower in different options for this 5 to 10 unit small multifamily loan option. One of the great new features now, again, 1.0 DSCR up to 3 million. That's a new feature. The ability to use short-term rental income to calculate the DSCR and qualify the borrower is another new feature for these 5 to 10 unit small multifamily properties. Previously, they were long-term rent only. And on the short-term rental, just like in some of our regular 1 to 4 unit DSCR options, we're able to use short-term rental revenue reports. We're able to use AirDNA on purchases and refinances when the property has recently been put into service because it was just remodeled. And we're also able to use bank statements evidencing the short-term rental deposits. So those are pretty interesting features on short-term rental that were not possible before. I'd say 7 months back, 6, 7 months back, that this was not available, but it is now. So, what are our eligible borrowers investing? Well, you see right there, I'm going to jump right to the bold red foreign nationals. We do have options now on the 5 to 10 unit DSCR for our foreign national borrowers. The same option that allows us to use short term rental income also allows us to offer this to foreign national borrowers, which until recently was not possible. Please note, inexperienced investors only with either if they don't own a property, if they don't have at least 1 year's ownership, they should have at least 1 year's small multifamily management experience. No experience or first-time home buyers are considered on an exception basis. It's going to depend on the merits of the file, right? Compensating factors. So, U.S. citizens, permanent residents, non-permanent residents, and foreign nationals are possible. Vesting in individuals is possible. Prefer in a U.S. based entity like an LLC or a corporation. Please note that you cannot have layered entity ownership, right? That's a definite complication that can happen. If you do, then that's another turn it in for an exception and see if they'll take it. But what you definitely cannot have is any foreign based entities owning any property, nor any foreign based entity owning the other entity. That'll definitely disqualify the loan. And please note that IRAs, blind trusts, land trusts, and most inter vivos revocable trusts are not acceptable forms of vesting. So, when in doubt, grab all of your entity documents, turn them in for a preview by underwriting, and they'll confirm for you if they are acceptable or not. So, what are our credit and asset requirements? Well, again, here, remember, I'm drawing from multiple options, trying to highlight the strengths here, how flexible we are. In our commercial option, we can go as low as 650. You heard me correct, 650. In our DSCR hybrid option, we can go as low as 660. Now, for maximum LTV, our hybrid DSCR option is maxed at 75% for a purchase and 70% for an LTV for a cash out. Now, keep in mind, obviously, our hybrid DSCR option is going to be a little bit more relaxed than the commercial option, except for the LTV, right? And the credit score being a little bit lower. But the fact of the no zip code situation that we don't have to take into consideration, that's a big one, which adds some additional risk to the file, hence the lower loan to value of 75 on the purchase and 70% on the cash out for the hybrid. And for a commercial option, purchase, we can go 80% LTV and cash out 75%. And now a very interesting point here to note with our commercial option, 90% combined loan to value is possible with a 75% LTV first and a 15% LTV seller second. That means first mortgage from us, 15% second mortgage from the seller. Seller's going to have to hold that paper. Gifts with a minimum 5% borrower contribution are possible. So now the gift cannot be used to meet the reserve requirement. So if your down payment is 25%, you can have a 20% gift and 5% down payment from the borrower, and the borrower also has to have assets that can be verified to meet the reserve requirements. And what are the reserve requirements, you may ask? Well, they vary again between option to option. So I'm going to give you the typical reserve requirements, and from there you'd have to go into the specific guidelines for the option you're looking at to see how they vary. So you're looking at up to $1 million loan amount, 3 months reserves required, 6 months PITI. Now we're talking 6 months of PITI, 3 months of PITI. So 6 months PITI for $1 million, $1 to $2 million loan, 9 months PITI reserve for loans over 2 million, and 3 months for each additional property. And this is max 18 months in total reserves you could ever be asked. So those are the reserves that we're talking about that cannot be met with a gift. So what are our minimum property requirements? Well, minimum property requirements, you're looking at minimum size of 400 square foot per unit, right? So that's not that big. Now, here's a really important note. Each unit has to have a full kitchen and bathroom. Full kitchen meaning a range to cook with. I mean, if it doesn't have an oven, you could probably get away with that. If it has a built-in cooktop of some type that's permanently installed, you could probably get away with that. Could have a tabletop type oven, but you do need to have full kitchen and a full bathroom. Now, here's one that can come back at you without you knowing what's happening. On the appraisal, the property use has to represent the highest and best use for the property. Now, that should usually not be an issue for a multifamily property. Being a multifamily property, can't usually use it for too many other things. But it, may be an issue if it's surrounded by commercial properties and is the only residential property on the street, and the appraiser feels that the highest and best use would be to convert the property into a retail shop and rent it for more money per square foot than residential. That can happen. Now, the property cannot be rural, right? That means that the appraisal cannot have stamped on it rural. However, you are able to have a property with anywhere from 2 to 20 acres, right? So that's, if you have 20 acres, you may be rural, but just note it's not automatically going to disqualify you if you have a big acreage property, I guess is the point I'm trying to make here. Minimum C4 or Q4 condition. In other words, if it's C5 or Q5, it's a no-go. Minimum 12 months cash out seasoning for market value. That's a little bit different than our regular DSCR. The property cannot have any environmental issues. No excessive nor structural deferred maintenance. And here's another real interesting point. Any unleased units must be in lease ready condition. So that can catch you by surprise if you think they're going to use the market rent over the lease rent. They will do that, but the unit cannot be in a position where it needs renovation. It can be vacant, but not needing a whole bunch of stuff. So you can see how in your 5 to 10 unit multifamily is a little bit different than, once you go above, 11 to 20 to 30 to 40 units. So this is a really good sector of the market, which is, I believe, to be a little bit underserved. Depending what part of the country you're in, you could have a lot of these types of properties. These types of properties tended to be developed, not new phenomenon, right? The small multifamilies. So depending what part of the country you're in, I mean, if you're in the suburbs somewhere and everything is from 1990 and 2000, you probably won't have too many of these properties. But if it's an older developed area, you probably will have many opportunities to finance 5 to 10 unit multifamily properties. So here at the Mortgage Calculator, our loan officers are loan consultants and can definitely be there for you to help structure your small multifamily properties, either as a DSCR or as a commercial, right? But typically, most of our borrowers are going to like that pure DSCR option because some of the commercial options may go DSCR on the property rent, but then have some type of a personal financial statement that needs to be provided by the borrower to make sure that they're able to cover their own personal expenses. So, looking forward to helping you all structure your small multifamily loans here at the Mortgage Calculator.
All right. Thank you, Jose. Okay, I don't see any questions here. I see one question, but I think it was already basically answered. Oh, here comes a question. Okay, let's put it on the screen here. Jose, do we currently have non-del options for this or brokered options?
Yes, we have all the options that I mentioned to you, that I shown here today were non-del. The commercial option is a brokered option as our commercial options. We don't fund the commercial loans, but we certainly fund all of the DSCR loans up to the 8 unit. I believe we can fund those in house.
All right. I don't see any other questions, so I think we can go ahead and wrap it up. Now, tomorrow is actually a holiday, so we normally do this Tuesdays, Wednesdays, and Thursdays at 7 p.m. Eastern, but this week we will just be doing it Tuesday and Thursday. So we appreciate everybody tuning in, and we will see you on Thursday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage